Hey everyone, welcome back to the channel. Today we're diving into a topic that's both exciting and crucial to understand. I'm talking about cryptocurrency. I love crypto, it's revolutionary, constantly transforming our lives and unlocking incredible opportunities. But as we embrace this digital frontier, it's essential to stay grounded in reality. While cryptocurrencies and blockchain technology offer us unprecedented freedom and impose a new level of responsibility, it's very empowering to know that we can control our assets directly without intermediaries. However, this freedom comes with the need for heightened vigilance. But let's not shy away from the fact that there is a darker side to this world. Yes, crypto can be a playground of possibilities, but it's also a landscape where risks lurk in the shadows. Today we're going to explore this hidden risk in our video. This might be a controversial topic for some, but the goal of today's discussion isn't to scare anyone away or to criticize the innovations we've seen. Instead, it's a STEM reminder to always remain alert and cautious. We need to understand that while blockchain gives us power, it also requires us to be much more proactive about our security. In October 2008, a paper titled Bitcoin, a peer-to-peer electronic cash system, was published, announcing the creation of one of the world's first cryptocurrencies. This paper was written by Satoshi Nakamoto, the inventor of Bitcoin. Nakamoto then created a message board called Bitcoin Talk and wrote, "I've developed a new open-source P2P e-cash system called Bitcoin. It's completely decentralized with no central server or trusted parties because everything is based on cryptographic proof instead of trust. Give it a try." Obviously, people did. But who is Satoshi Nakamoto? The short answer is no one knows. There's at least one real person behind this alias, because someone wrote the code for Bitcoin, published a paper about it, sent emails, and made forum posts about the new digital currency. But beyond that, Nakamoto's identity remains a mystery. Some even think it's Elon Musk, but he denied the rumor. An Australian computer scientist named Craig Wright claimed to be Nakamoto and was awarded copyrights on the original paper published on Bitcoin at its early code. Although the validity of his claim has been called into question by many journalists and lawyers who have followed him through multiple court cases, there was even a Japanese-American physicist named Dorian Nakamoto who many thought might be the elusive crypto god, but he insists it wasn't him. Perhaps one of the reasons that Satoshi Nakamoto will never come forward is because they own about 25 billion in Bitcoin that has never moved. And sometimes anonymity is the only way to feel safe. It makes sense that one of the largest contributors to the cryptocurrency world would want to remain completely hidden from the public. After all, anonymity is one of the biggest selling points of the entire invention. But before we continue, remember that more interesting stories, trading or crypto theory, and most important news are in our free Telegram channel. So you just need to go down below in the description and you have access to the latest news, analysis, and a bunch of useful materials. Let's move on. Cryptocurrency or digital currencies verify and record transactions to a decentralized blockchain. A blockchain is essentially an immutable public ledger. Once transactions are completed, it's final and irreversible, and every person on Earth can view it for themselves. Despite not having an identity tied to it, it offers a way to move money outside of central banks and financial institutions, giving people a perceived sense of freedom and safety in their financial lives. But the reality is that although anonymity can give us a sense of safety to some people, it also can be extremely dangerous. The anonymity promised by cryptocurrency isn't only appealing to those who are skeptical of traditional financial institutions, it's also a useful tool for criminals, dangerous people who want to bypass banking systems and move money anonymously. Dealers and users buy and sell drugs and even darker legal goods on the internet while avoiding the watchful eye of law enforcement. This works because although all transactions are tracked and recorded, there is no personal information tying an individual to their crypto keys. It's just a random hash of numbers and letters, hardly representing any information at all. This has led to terrorists, people involved in human trafficking, and drug dealers seizing upon the technology for nefarious gains. The Silk Road, one of the most famous online drug market on the dark web, used crypto for its transactions. The US Justice Department has also dismantled at least 3 terror finance campaigns that were soliciting cryptocurrency funds. Also, the rise of cryptocurrency has fueled growth in global ransomware attacks, which has seen a 185% increase in recent years. In 2021, the FBI seized 2.3 million worth of crypto from the Referral ransomware group, who hacked US security and IT management software provider Kaseya. Not only do these cyber hackers demand crypto as payment, but crypto makes their whole business possible. And it isn't just large companies that have to watch their back online. Crypto scams coercing people to invest in fraudulent crypto funds or fake cryptocurrencies are rampant. Last February, Satish Kampani of India, the founder of BitConnect, was indicted by the US Justice Department for creating and running a fraudulent cryptocurrency investment platform. The Monetary Authority of Singapore suspended a crypto coin illegally named after the world-famous South Korean boy band BTS. And after the success of Netflix's Korean hit Squid Game, scammers used this serious popularity to create fake crypto coins. The value of the coins skyrocketed to 300,000% in just 11 days, which sounds very appealing. The catch, though, is that this coin was just known as a honeypot. Essentially, you were able to purchase it, but you weren't able to sell it. Because of it, you traded your dollars to the Squid Game coin, and the scammers escaped the millions in cash from unwitting investors, leaving them in token that couldn't be sold and literally was worthless. Now, you might say, well, scams happen at all financial institutions, and you'd be right. But at least, with many third-party backed institutions, you get protectors that crypto just doesn't offer. If your regular credit card gets hacked, you'll usually get your money back since your bank or financial institution has consumer protections. With crypto, those protections don't exist. So then hackers get access to your private keys, or you get scammed into buying a fake coin, or you just invest in a fraudulent exchange. Once you give them your crypto, well, it's gone forever. In 2021, there was a reported 3.2 billion in crypto stolen, a 516% increase compared to the year before. And as new technologies involving crypto and blockchain technology become more popular, a new wave of crypto and NFT scams will inevitably rise. NFTs, non-fungible tokens, are blockchain-based tokens that represent a unique asset like a piece of art, music, or other digital content that can be purchased with cryptocurrency. They're meant to give artists more control and freedom over their work, but we don't live in an ideal world, do we? So, although NFTs were, in a sense, invented in 2014 with the creation of Ethereum, the real NFT revolution began to boom in 2021 with the help of artist Mike Winkelmann, also known as Beeple. His digital artwork, called Everyday's The First 5,000 Days, sold for $69 million and helped put NFTs on the map. Since then, artists and collectors at every scale have benefited from the creation of NFTs, but they also experienced the same rampant scamming in all areas of the crypto world. A crypto investor who goes by Metacoven bought Beeple's NFT for $69 million in 2021 and also happens to be the owner of the world's now largest NFT fund, which studies data to provide analysis on various NFTs. Is $69 million a lot to pay for a digital piece of art? Yes, but what if it brings in far more than $69 million to your business? Some say that Metacoven's purchase of Beeple's NFT allowed him to drive up prices in his own NFT business. NFTs have, in a sense, become a game of who can tell the most believable lie. It was once reported that an NFT called CryptoPunk #9998 of the white-haired, green-eyed, pixelated character sold for $532 million. It was said to be the most expensive NFT of all time until it turned out that the buyer and the seller were initially the same person creating a fake valuation for their own benefit. In the crypto world, transactions are conducted anonymously on the blockchain. While the wallets involved in the transactions are visible, the identities of their owners are not. However, the transparent nature of cryptocurrency allows anyone to view interactions between these wallets on the blockchain. If overestimating the value of digital art were the only issue, NFTs might not have such a negative reputation. After all, determining the value of physical art is also subjective. Well, unfortunately, overvaluation is just one problem associated with NFTs. NFTs have been associated with numerous scams. For instance, in February 2022, Sand, a small but established NFT marketplace marketplace had to suspend sales due to widespread fraud. Users were creating counterfeit digital assets despite the platform's efforts to prevent this. This situation underscores the importance of the popular crypto principle: don't trust, verify. With a fully public blockchain, users can verify every transaction to verify and ensure they are purchasing from the original creator. Unfortunately, many users overlook this crucial aspect of cryptocurrency. In another case, a fake Banksy NFT was sold for over $300,000. One of the challenges with NFTs is that those entering the digital art space for creative reasons are often marginalized. Enthusiasts often use platforms like Discord, Twitter, and Instagram that can also be exploited by hackers. These hackers use deceptive links to lure unsuspecting NFT buyers with promises of cheap mining opportunities or free airdrops. Victims may invest their cryptocurrency in NFTs that do not actually exist, resulting in their funds being lost and stolen. Even Beeple's fans haven't escaped unscathed. In May 2022, scammers hacked Beeple's Twitter account and stole $438,000 worth of crypto and NFTs from his followers. They impersonated the artist, claiming to have launched a new line of digital art with Louis Vuitton and posted a raffle for the fake collection in his Twitter bio. The hackers used a phishing scam, deceiving people into relieving sensitive information or unknowingly installing malware. Once they clicked the link in his bio, all the crypto and NFTs in their wallets were completely wiped out. The fragility of the crypto universe was clearly evident in the recent collapse of the cryptocurrency exchange FTX. FTX was the brainchild of Sam Bankman-Fried. He was the founder of the quantitative trading firm Alameda Research in 2017 and then FTX 2 years later. As the majority owner of both firms, there was initial concern over his conflict of interest, but he assured people that they were separate entities. Unfortunately, that turned out to be a lie. Contrary to what Bankman-Fried said, FTX used his customers' money to find risky bets made at Alameda. They would take customers' deposits, sell them on FTX to regular traders, and then use the cash to invest in other companies. To take it even further, these companies they invested in would often be stored their treasures and accounts on FTX, where the funds could even be used again in Alameda, and the snowball continued to roll. So on November 6, 2022, the world's largest crypto exchange, Binance, which was also a leading angel investor in FTX, said it would unload hundreds of millions of FTX tokens. This is also around the time a leaked balance breakdown came out, showing that the majority of FTX collateral was in their own FTX token. As you can imagine, if Binance were to sell hundreds of millions of this token, it would drive down the price and, in turn, drive down the value of the collateral that was held in FTX, collateral that was supposed to be customers' assets. An OTC or over-the-counter deal was offered by Alameda to purchase them at $22 per token, but that wasn't taken. The market called their bluff, and within 48 hours, FTX's token was down 93%. Days later, the US Securities and Exchange Commission and Justice Department began investigating FTX, and on November 11th, Bankman-Fried resigned from both companies and FTX filed for bankruptcy. In many ways, the FTX collapse seems like a traditional financial catastrophe, the kind we saw during the 2008 financial crisis. But crypto, with its promise of anonymity and its assurance of no go-betweeners, makes the FTX disaster very different. Millions of dollars in FTX funds were stolen during the bankruptcy process. No one knows by whom. The collapse of FTX has prompted other cryptocurrency exchanges to emphasize their cash reserves and advocate for increased transparency. Even for those not actively involved in cryptocurrency trading, the industry has faced significant negative publicity. Recently, Silvergate Capital, a major bank supporting crypto clients, failed during the crisis that affected Silicon Valley Bank. Silvergate entered the crypto sector early and collaborated with numerous tech and crypto companies, achieving a valuation of $6 billion in 2021. However, it has since experienced a significant decline in value. Additionally, as cryptocurrency gains popularity, particularly among younger demographics, concerns about its environmental impact has become a prominent topic of discussion as well. In 2021, Cambridge University researchers calculated that Bitcoin mining was using more electricity than the entire country of Argentina. This huge carbon footprint on blockchain technology has alerted people, especially those who care about sustainability, to crypto's sizable contribution to climate change. However, the Cambridge Center for Alternative Finance estimates that Bitcoin uses just over 100 terawatt hours of energy per year to facilitate transactions and keep the network running. In reality, this is actually less energy than what is used to gold mining in a year. In fact, the iron and steel industry uses over 10 times this amount of energy on an analyzed basis. If Bitcoin was a country, in terms of energy usage, it would rank 32nd out of 59 tracked by the Cambridge Center. So yes, even though Bitcoin mining does use quite a bit of energy, it is far from the biggest problem on this front. What effect this will have on the future of cryptocurrency depends on people's continued desire for the anonymity that crypto provides. The anonymity that allows you to transact back and forth anonymously with anyone, in the same anonymity that allows criminals to run rampant and scammers to run off with millions. It's a double-edged sword. However, it's getting easier for investigators to track crypto exchanges by deciphering patterns in the blockchain. There's a small group of detectives who have become adept of tracing cryptocurrency crimes for law enforcement agencies, and a crypto tracing firm, Chain Analysis, has emerged to find these patterns. They find groups of blockchain addresses that come from a single person or service, follow the money from those clusters, watch it move, and eventually figure out which exchange the money came from. In the US, crypto exchanges are legally required to retain identifying information about users under the KYC rules, standing for Know Your Customer. So, the premise of anonymity, the one that the entire argument of crypto hinges on in the first place, isn't always so certain. There are currencies on the market that appear to be more untraceable than their competitors. Monero, which has been adopted by dark web markets, claims to be untraceable at all. Zcash is another that gives even the best traders trouble, leading many to fear it will provide safe harbor to criminals and people evading taxes. The question is whether law enforcement and other agencies will be able to keep pace with the rapid development of new blockchain technology. So far, their efforts have been relatively successful. In 2021, criminal investigators by the IRS led to the seizure of over $3.5 billion in cryptocurrency. The Justice Department also seized $56 million, and $2.3 million was confiscated from the ransomware group responsible for the Colonial Pipeline cyber attack, highlighting the potential threats posed by cyber criminals. In 2022, a couple from New York was arrested for allegedly laundering money stolen through a hack of the crypto exchange Bitfinex. They had converted some of the stolen funds into Monero, a cryptocurrency known for its privacy features. Despite this, law enforcement was able to trace the funds and discovered exchange accounts in their names. Authorities also located the private keys to a wallet containing over 100,000 Bitcoin, valued at approximately $3.6 billion at the time, making the largest cryptocurrency seizure in history. The methods used to track those addresses remain undisclosed. And right before we continue, remember to check out our Telegram channel, since we tell about all the scams and ways to protect yourself. It is totally free, and besides that we share all important information that we wish had in our time. All the experience and knowledge we are sharing costs a lot, but we tell everything for free. So if you want to save money and energy, check out the link in the description. So, while crypto has its positive aspects for those seeking complete control over their finances, its trustless and anonymous nature requires extreme caution because the negatives can cut quite deep if you aren't careful. If you're going to get involved, be wary of scams, hold your own keys, and remember, don't trust, verify. Governments across the globe continue to look at how to regulate cryptocurrency before it gets too out of control by any measures. Unfortunately for them, bureaucracy tends to move very slowly, while technology, especially crypto, moves at a breakneck speed. Technology can be amazing, but then the creators don't put measures in place to curb the potential negatives of their creations. We can be left in a pretty bad situation. Write down in the comments what you think. Do you agree with my point of view, and did we not mention some significant cases that prove my point? Remember that your comments and pieces of advice improve our videos for you.